This one's important. Code of ethics. Oh, what I was going to say is I might use these videos I've done talking about the stuff and have people do independent study. Now, who made the comment you could do this class? That was you, wasn't it? Insulting, but you're right. You can do pretty much anything by the time you're a senior in independent study. You really could. Yeah. Except for Richard's class where he didn't have anything in a book. Yeah, I agree with that one. Yeah. But most of them could. I think you could do principles of accounting independent study too if you were really focused.
How about you use this as test dummy? And we'll finish this class out of it.
Okay, I'll tell you what. You never have to. Well, it's already that way. You could not come to class and just do all those exams, and I'll give you your grade. You don't have to do it. It could be your grade anyway. Classes are optional. You remember principles, right? Everything's optional.
Yes.
It's like when you go to work in your career, everything's optional. You don't have to go to work. You don't have to pay it, but you don't have to go to work. Right? Remember, you don't have to do anything. It's a free country. You can go out in that snow outside. There's none. Okay, you can go out. There's a little tangent over there. You go down by that creek and you can just stay there. Free country, right? I'm not bringing you any food. I'll wait once in a while. Yeah. Everything. It's a free country. Everything's optional. Yeah, you don't have to know this stuff. That really helps me to know that. When I'm doing something I don't really want to do at work, faculty meetings, stuff like that. And, oh well, at least they're paying me to suffer, so something like that. It's not that much suffering. In response to the Sarbanes-Oxley Act, the SEC now requires each public company to disclose whether it has adopted a code of ethics that applies to senior management. Okay? Senior management must buy in. They must have a code of ethics. There's been some really incredible frauds where senior management said, we don't need a code of ethics, we're ethical. And then they turned out to be frauds. So, yeah, they didn't need a code of ethics. They didn't want anybody following. The SEC also requires companies to disclose amendments and waivers to the code of ethics. So I think this is a good idea. Does having a code of ethics make you ethical? Of course not. Does not having one make you unethical? Of course not. But is it a good idea to talk about ethics sometimes in your organization? Of course. So that's what this is about. So let's do it. Let's take it seriously. Good. All right. Client objectives and strategies. Strategies are approaches followed by the entity to achieve organizational objectives. Auditors should understand the client objectives. No kidding. The client objectives are what are driving their business, right? And then client makes what? Relating to their financial statement. Their objectives are what they're running the business to accomplish. What do they make in terms of their financial statements? The representations in their financial statement. What were those things called? I don't even know what they were called, much less what they were. We don't have a test for a while. Management makes assertions. Yeah, the major assertion is that their financial statements fairly present the financial position of the company results of operations for the periods in cash flow. So that's the major assertion they make. But then within that, they have all those different ones. What are some of them? Yeah, okay, existence. Okay, consistency. Consistent. Occurrence. Okay, occurrence, existence or occurrence, right? Completeness. I think the cutoff is part of it, right? Yeah. And presentation disclosure, right? What did we leave out? Rights and obligations. Accuracy, consistency, and accuracy kind of go together. Yeah. Okay. Right, guys? What else do we leave out? Rights and obligations. Yeah, I mentioned that. You got them up there now? Got them up now? Mm-hmm. Read them up.
The three categories: occurrence, completeness, accuracy, classification. We got all. Existence, completeness, valuation, allocation.
That's what we didn't do. Valuation, allocation. Okay.
Rights and obligations, occurrence, rights and obligations, completeness, accuracy, valuation, classification, and understandability.
Okay. And understandability is the overall. He's doing all those different categories. Okay. Substantive test the controls, test the details. Substantive test and fix the. Okay. Good. So you know those things. And then, by the way, those management assertions lead to our what? We have other objectives. Okay, so the client has their objectives that they're going to meet, right, and their strategies to achieve those objectives. And then when we do the financial statement level, the assertions, and then when we talk about what we're doing in the audit, we have audit objectives because it's what we want to achieve in the audit, huh? It's all ties together. Okay, so financial reporting reliability, of course, effectiveness and efficiency. You know about the 3 E's? Did you talk about that in the BA 345 class? Doing systems, right? Do some systems in there. And then in the 400 level systems class that you guys have you done that yet? You've done that one? Dave Collins has county made. Okay, sort of capstone class supposedly, but it's really a systems class. Anyway, what are the 3 E's? 2 of them are effectiveness, efficiency. Effectiveness is what? How well you do stuff. I'm effective. I do a really good job, right? It works. The internal control is effective. The audit procedure is effective, right? Does a good job. That's what I went into. And efficiency, what's that? Do it quickly, low cost. So what do you want? Both of them. You want effective procedures, right? That are efficient, low cost. Okay, and sometimes we trade those things off, but the ideal thing is to get both. Rather than control, it's inexpensive, fast, which fast and inexpensive are sometimes the same thing, right? Okay, fast and inexpensive, and then very effective, that's nice. Auditing procedures, some of them are real effective, but they're not very efficient. Give me an example of one. Real simple. Confirmations. Absolutely. Observations, maybe. Right? Okay. Give me one that's really efficient, but maybe not very effective. Have a conversation with a client. What did you say? Analytic procedure. Better yet, I like that. Analytic procedure might fit in that category. Not as effective, maybe. But some of them are pretty effective, and they're still really efficient, and we like that. You know, so you're balancing this stuff all the time. So what's economy? It's the 2 added together, right? Economy would be effective. It's both effective and efficient, and therefore it's economical. You like it? Economy. That's kind of use those 3 things. Do you remember that from your? Yeah.
Heard earlier in one of the chapters.
Yeah. Okay. In our book? Oh, in our class. I meant from the systems class. But it is in here. Yeah, it's in here. I didn't think about it later in here. I don't know why. Okay, measurement and performance. Clients' performance measurement system. So what are they marking? What are they measuring? And it doesn't. The point of this is, does it have to be just financial statements? Of course not. So are they keeping track of what's going on in their company by a whole bunch of measures? We use at schools I used to be at. I don't know why we don't do it here. We count students here. At other schools we counted what's called FTEs, which is a far better way to go. Full-time equivalent. So if you have students that are only taking 3 credits, you know, they're 1/4 of a student or something, and students that are taking more, 12 would be a full student. People are taking more than 1 student. So you're measuring how much teaching you're doing instead of measuring how many absolute bodies you have, right? Better way to track what's going on in an educational institution. Just an example of what you might do, right? What kind of things could you track? Would units sold be more important than dollars sold? Maybe, right? Because sales prices change, and yeah, whatever. Okay. So all kinds of performance measures. You need to know what those are, of course. All right, we're going to assess the client business risk. It's the risk that they'll fail to meet their objectives, which ultimately is what? They go bankrupt, right? But obviously it's just achieving less than they expect to or they plan to, right? And so, all right, so what's the auditor's primary concern? They'll make material misstatements due to the client's business risk. How would they make a material misstatement? 2 ways. One is they could have horrible internal control, or even despite of internal control, maybe somebody would go around it and intentionally misstate or something like that. But you could, the horrible internal control would be you accidentally make a mistake, I suppose, right? And your system doesn't either prevent it or correct it. Okay? What would be the other possibility, though? Material misstatement due to financial risk, business risk. They're in trouble. They know they're in trouble. They don't want their shareholders to know. They don't want the bank to know, right? What do? Lying financial statements, okay? So business risk obviously can lead them to have motivation. Remember that little triangle thing? You can always go back to that. They might have the motivation, right? Incentive, okay? And the incentive gets bigger as you get in more trouble, right? If you ever have a friend that are close to flunking a class, be real tempted to cheat? Never happened to you, right? Okay, but yeah, but people are. They're more tempted the more in trouble they are, right? It's true. Okay. Okay, so need to understand the industry. We need to understand how the business works, what management system is and governance. We talked about that of the organization, their objectives and strategies, how they're measuring it. And so if you understand all of that, then you could have an understanding of the client's business and industry, and will assess the business risk and assess the risk of material misstatements based on all of that. Okay, and you guys know about it, inherent risk, control risk, detection risk, right? Okay, all combined together for audit risk, the way we would think about it. Okay, so what do you think about, if you're understanding the business and industry, will that help you with inherent risk? Yeah. But might it help you a little bit with control risk? How the business is being run, governance structure, management and performance? Getting the idea here? Okay, so can they reduce their business risk by having good internal controls? Yeah, it's not just talking about the audit, it's talking about running your business, right? The reason your clients should have strong internal control is so they are more profitable, not so that you have an easier time doing the audit. Make sure that's the way you approach this, and they'll be far more excited about implementing your internal control suggestions. Oh, by the way, will it make their audit cheaper? Yes, and you do point that out. I'm going to take an awful lot of time doing stuff because, you've got a person who's making 15, 20 bucks an hour. If you want, you can give us 150 an hour to do it. 15, 150. What do you think? And they're going to be far more efficient than me because they're going to have fun doing it, and I'm going to be pissed off while I do it. Right? If you have a good relationship with your client, they get the message. Anything that you can have a client, employee do instead of you, without compromising your audit, hurting your independence, all of that, right? Compromise the evidence you collect or something, right? Why not? I don't want to do anything personally. If I can teach you how to do it, get you to do it for me, what? Right? That's the kind of senior you want to work for too, right? They're lazy, aren't they? Good seniors are really lazy. Would you do this? Would you do this? Would you do this? Would you do this? They're not really lazy. They're going to do something else, right? The manager's dumping on them. So, yeah. And they're thrilled about it. Well, maybe. Okay, management must certify it has designed disclosure controls and procedures. So they're going to actually sign. Who signs? Chief Executive Officer and the Chief Financial Officer, CEO and CFO, whoever those happen to be. Okay? To design disclosure controls and procedures to ensure that material information about business risks is made known to them. Management must certify it has informed the auditor and audit committee of any significant control deficiencies. Management certifies that. It used to be that was more our responsibility, all of this stuff. Okay? They would give us a management representation letter, still doing non-Sarbanes-Oxley engagements. Although, you know what? Most smaller firms do this stuff now anyway, even though they don't have to. What happens is that we get regulations in, requirements in that are required under federal law, and therefore by the SEC, right? What do we tend to do? They trickle down, and everybody just does it. Why not? Everybody has audit committees of their board now. If it's any size company at all, public or private, wouldn't make any difference. This is a really good thing to do, right? And by the way, before Sarbanes-Oxley, most large companies already had them, right? Now they're just required. You can't get around it, okay? Well-run companies would do it anyway. Okay, so analytic procedures, yeah, so we do all these tests. What are we going to do? Unusual changes in ratios, okay, and they show some examples. They calculated a whole bunch of ratios, and they're comparing what? That should be Hillsburg industry and Hillsburg to Hillsburg, right? So you can compare what's going on to you compare to the industry in both years, and you compare yourself to yourself, huh? Pretty good idea? Benchmarks? What can you compare to? Your history, industrial averages, and what else? What your expectation was? Develop an expectation. That's all, just developing expectations. My expectation might be that I'm about the same as last year unless I have reason for it to be different in a particular ratio, right? That might be an expectation. My expectation might be, well, I am the same as industry averages except for where I know I'm going to be different, and I know why I'm different, or I investigate why I'm different. If I'm different, it's the first time through on a client, the first time I've ever done the audit, you might do these and ask the client, why are you different than industry averages? You did it on purpose, or is it out of control, or what's happening? Are you aware? Why do you have a current ratio that is much smaller than the industry, right? Okay? So, or much, in this case they did, although the industry, in this case, their current ratio is a lot a really high current ratio. So compared to what your expectation would be of just what's normal. Okay, so why is the industry so high? That'd be a nice question. What's going on here? And then why, but it might be just that they have massive inventories, but then if they have massive inventories, why don't they have massive accounts payable to offset it? I don't know. And then you can look at the inventory turnover. This is kind of scary. I mean, our receivable rather turnover here, right? You can look at inventory turnover too. What do you think about that receivable turnover? They're far slower than the industry. Not good, huh? They're about the same as last year, but they're slowing down a little bit. Look at it. They're kind of nice, aren't they? You can look at this stuff. What do I expect and what do I get? Okay? So make sure you calculate the ratios the same as the industry did. Right, guys? Remember that in principles? When I say calculate your own, right? Make sure you know how they calculate it, and you make sure you calculate it the same way, so you're comparing, something apples and apples. Okay, summary of the parts of audit planning. A major purpose is to gain understanding of the client's business and industry in the planning. So we're already doing auditing when we do the planning, guys, right? And we're going to document that. So set materiality, assess acceptable audit risk and inherent risk. I told you audit risk is going to be usually 5 or 10% risk of what? Audit risk. Of having the improper opinion, right? Giving an unqualified opinion when it should have been qualified or vice versa, right? That's going to be what? Audit failure. So audit risk is the risk of audit failure. Said that over and over. I don't see that stuff. Okay. Anyway, so what is it typically in a firm? 5 or 10%. Just grabbing numbers out of the air, sort of. But if you think about what a firm is doing, if they say 5%, are they more risk averse than a firm that says 10%? Yes. Might the one that says 10% be willing to take some clients, the one that wants 5% could not take? Yes. Now, might they have higher fees as a result? Maybe. Might you come back and find them later? Maybe. Yeah. But these are just kind of subjective things, right? So, yeah. Do you know what the audit risk is in the firm you work for? They don't even talk about it, do they? But believe me, the partners. They talk about where are we going on these things. Where do you, and by the way, would the risk be different on different clients? Absolutely. Of course it would. Okay? So ultimately, certainly, when you take your final estimate of control risk times your final estimate of protection risk, or I'm sorry, final estimate of inherent risk times the final estimate of control risk times the final estimate of detection risk, you're going to get an audit risk, right? Might it be different on different clients? Oh, yeah. You can decide whether you're willing to live with that or not. What if it's too high? What can you do? It's too late to do more to change the controls. You can't change inherent risk. It's too late to do anything about changing the controls. You already tested, you found out what you found, right? What can you change? Detection risk. What can you do? Keep working. Get more substantive work done, right? Substantiating those ending balances and testing transactions, that sort of thing, right? You can still do it, but is that pretty expensive? Yeah. If you give a fixed fee bid, whose hide will that come out of when you do more work to make yourself more comfortable? Yours. Firm will pay for it. They won't recover it, typically. Unless you got surprises. If you write a good engagement letter, right? If you have to expand beyond a normal scope, they pay, right? If your controls weren't as good as you represented, okay, got the idea? Or there are more errors than you represented. And what was the other one I suggested? If they don't get the prepared by client schedules to you, they don't give you the inventory, they don't give you the list of receivables, whatever it is, right? They don't get it to you on the schedule, then what happens? We push it back, which makes it more expensive for them. Right? What's going to happen? I have billed clients before for sitting in their office waiting for them. Not the first time, but after that. And I let them know I was. You are paying, whatever, $100 an hour to sit for 2 hours in your office waiting for you. And they'll say, well, yeah, but you're working on something else. I don't care. I'm very inefficient. I'm sitting in your office. I didn't really double bill. I gave it to them for free to charge to you. Right? They catch on. Okay? So, play a little hardball once in a while, guys. Don't lose your clients, though, because you're mean. I'm not suggesting that. Okay, anyway, so understanding internal control, obtain an understanding, assess control risk, preliminary assessment, and then we're going to test it, okay? At the planning phase, are you testing the controls? No, right? You're obtaining an understanding. Would you do walkthroughs to get your understanding? Sure. Are you going to understand what they do unless you walk through what they're doing, right? Look at all the documents, talk to people that are doing it, walk through the process with them, okay? All right? You can learn a lot that way. Okay, develop the overall audit strategy. Yes, that's right, risk, of course. Okay. All right, we beat this to death. Are we done? Required during the plan. Required during the completion. often done during the testing, and I absolutely love them, so I always did them during the testing, right? Why not? Save you a lot of time, a lot of hassle. All right, timing of them. Well, guess what? During the planning phase, it's the primary purpose, right? Understanding the client's business. Secondary purpose always is assess going concern, right? Indicate possible misstatements, right? Yeah, primary purpose. Reduce detailed tests. The planning phase, if all those ratios look good, maybe you can do less substantive work already. But you got to make sure the controls are really good. Okay, during the testing phase, biggest thing is reduce the detailed tests, huh? Substantive testing, test the control, or tests of transactions, and substantive testing. Do you guys understand what I mean by now? I've said it a million times. But do you understand what I mean by the difference between test of controls, test of transactions, details of transactions, and substantive testing? Test controls are finding out whether or not the internal controls are operating in the way you thought they were, right? Based on the design of them, your understanding of them, and your preliminary evaluation, right? That's tests of controls. These are real stuff. What's tests of transactions? Details of transactions. The journal entries are what make the ending balances, right? The transactions are reflected in journal entries. It's testing what went into those journal entries. Do they have the right numbers, or what went into the sales journal, or the purchase journal, or whatever? You got the idea? That's the transaction, which is what's being built up into the ending balances. We rely on that a lot for what? Income statement stuff. A lot more on income statement stuff. But it's good on the balance sheet too. And then what's substantive testing? The ending balance. We use that for the balance sheet a lot. You can also use it for the income statement, right? Depending on the type of account. How would you decide whether you were going to use test the controls, test the details, or substantive testing? What's more cost effective, efficient therefore, and what's more effective, right? So you get a good job. So you're constantly doing that. On different engagements, you'll do different things, huh? Right? I don't know. I told you about the idea of doing a test of interest expense, and they show you an example in the book, don't they? Right? Okay? I talked about doing a test of interest expense, and then it was an analytic procedure example they showed you both. If I had one note payable, bond payable, I would not use an analytic procedure. What do you think I would do? I think I would take the amount of the bond times the interest rate on the bond and calculate exactly what interest expense would be on the bond. And I have done a direct test of the balance of it. You like it? Why would I possibly use an analytic procedure and estimate that I can calculate what it exactly is faster? Got it? Extreme example there, but you could do that, okay? So this is all over the map how you would approach these things. There's lots of judgment involved. Okay, anyway. And then required at the completion phase is to make sure there aren't the misstatements. And notice how this is pretty good, and then assess going concern. What's the primary purpose at the beginning? Find out what the hell's going on. What's another one? Are there misstatements? Because that's where I want to emphasize my auditing, right? Where might there be some I'm worried about? Less for anything else. What is it during the testing phase? I want to know if that balance is right, right? Reduce detailed testing, right? Okay? Substantive testing. Okay, test the details of balances and test the transactions. Okay, so by the way, what do you think is cheaper? Testing controls or test the details of transactions and substantive tests in general? In balance. Test controls are far cheaper. Another reason to have controls, of course. Okay, all right. And then at the end, what are we really worried about? Well, now the biggest thing is, are we done? Are there any misstatements? So it's a pretty good chart, okay? All right, you can compare, we mentioned this, industry data, similar prior period for us, client determined expected results, maybe budgets, auditor determined expected results, what we'd expect in the situation, knowing what we know, and then anything from the financial data that you can come up with, sure. And, yeah, by the way, when somebody gives you an explanation for why a ratio changed or why a balance changed, you do realize ratios are just one balance divided by another balance usually, right? Current ratios, current assets divided by current liabilities, right? Yeah, so you can either look at the absolute amount of the balance, you can look at the ratios, or you can look at the percentages. It doesn't make any difference. Okay, the percentage changes, or the percentages of total sales or total assets. Okay, anyway, if somebody gives you an explanation on inventory turnover, and then they also give you an explanation on why inventory turnover changed, and then give you an explanation on why gross margin changed, should those two explanations be consistent with each other? Or inventory change in account, or inventory turnover and accounts receivable turnover? You know, should they make sense together? Yeah, they can't tell you that the business is sped up, and that's why receivables receivables turnover is slowed down, because we're just selling, man, we're just selling a lot, you know, and we're selling to new people, and we haven't got the system set up, and we're not getting it collected as fast, and the sales are so big, and so that's my reason. Okay, and then they can't tell you in inventory, oh, well, the inventory turnover slowed down because, you know, our customers aren't buying as much. So you're the auditor, and you get both those explanations from maybe the same person. That's hilarious when you get that. But from two different, because now you know they're blowing smoke and trying to get rid of you, right? They're just trying to get rid of you. But if you get it from two different people, what do you think? One of these two don't know what's going on, or maybe both. Just like that. Okay? These explanations need to be consistent. It's a really good idea to call people on that really early in the process. So, oh, wait a minute, I have to give her or him a serious answer. I've got to think before I give them this explanation. They're not just going to write down the explanation I give them and leave. Although early in your career you might be tempted to do that, and you might do that because you're in a hurry and you're senior, you'll break you over the coals for it. Anybody get that one yet? Those are inconsistent explanations, and you wrote both of them down. Are you kidding me? It can't be both of those things. Their sales did not go up and go down. Besides, you could just look at sales and see what happened in that case, right? Okay, so examples they give you: raw material turnover for a manufacturing company. You can look at for misstatement of inventory, or cost of goods sold, or obsolescence of raw materials inventory. And all I would suggest to you in any of the ratios, what are the items that are in the ratio? I did this with you in principles, so you didn't know what I was talking about. When you calculate inventory turnover, what is it? Of course, it's cost of goods sold divided by average inventory, isn't it? Because, you know, inventory turns over into cost of goods sold, doesn't it? Debit cost of goods sold, credit inventory, sure. Okay, so what accounts are you probably going to be working on in terms of, is there a misstatement if you're using an inventory turnover? How about inventory? How about cost of goods sold? Although might it tie to gross profit? Might it tie to sales? Well, yeah, you sell your inventory. Your gross profit comes off the inventory. And then when you do the accounts receivable, does it tie back into inventory and cost of goods sold too? Of course it does. You know, sales and, you know, the stuff you sell is the stuff you have the cost for. Does it tie into commissions expense? Of course the sales tie to commission expense. Oh, do the number of units you sold and the weight of them tie into freight expense? Yeah, you got to understand the whole business and how it works, right? Exactly what they do. That's what it's talking about. Do you understand the business? What's really cool, you guys, I'm sure I mentioned this to you in principles, I always do, or try to. Earlier in my career, I was at Oyster Mushroom Farms, an Ostrom story. Yeah, anyway. Went into a meeting. I'd been there for a few weeks, and I went into a meeting with the top management of the company. And I'm a little kid, 23 maybe, and I'm in a meeting, maybe 24, in a meeting with the farm manager, plant manager, all that, manager of the cannery and stuff. And so after the farm manager, after the meeting, he says, "Keith, how could you possibly know so much about this company?" He says, "You know, stuff that took me years." You know what my response to him was? I read the financial statements. I'm not kidding. You guys can read financial statements, right? Do you see all the transactions that went into getting those financial statements? Oh, by the way, I also prepared the financial statements, right? I said, "You told me what's going on in this business. I've been talking to you ever since I got here, and all the other managers, finding out what's going on." It's just that you're the most curious person on earth as an auditor. You just talk. What about this? What about this? What about this? Your clients are going to think you're nuts. It's good. It's great. You just want to know everything about everything. Yes, you do. One, you want to know everything about everything so you know everything about everything. And it's fun, right? Find out about everything. What's the other one for? You want to understand the business. You want to know what you're looking for. What would you expect to see? What should happen? And then if something is really out of place, you're kind of like, what's that? So when we're doing this analytic procedure stuff, that's what we're doing, right? finding out what's going on. What would I expect, and then what do I see? Okay? So don't get mechanical about this. Be thinking. Anyway, so you can read all these. You can read them on your own, but we could spend forever on them. Let's not do that. Okay, so they're comparing data. What is this? What do they call it? Is this common size? Or is it common size going across? One's down, one's across. Horizontal and vertical analysis. This is vertical at least. Okay, but anyway. Common size statements. Maybe that might be what this is with the percentages. When you look at the dollars, you can't really tell what's going on. When you look at the percentages, it helps a little. Right? Dollars include inflation. Right? Includes growth, certainly, or shrinkage. Negative growth. All right. So, and then they want you to look at these, and do look at them. Think about which ones they are. You've done these before, haven't you? All the different ratios. Are there different methods of calculating some of these ratios? Yes. So look up what they're doing. If you find them online, what should you do? See how they computed it. If they don't tell you on the website where you found the ratio, how they computed it, here's my recommendation for you. Don't use it. If it's a major industry average, though, and you want to use it, go back to the data that they used for calculating it if you can, and do it again yourself. Right? Okay. Make sure. Anyway, so these are how they calculated all of them. We've beaten that to death in other classes. And by the way, are those really becoming just common sense to you now? When I said inventory turnover, so right, or accounts receivable turnover, the basic ones. Okay. And there's the summary. Yeah, we can keep it up. All right, let's try another chapter. See how much we haven't actually talked about. All right, I mentioned that you could take the material. What's material again? For the statements as a whole. The material amount on the balance sheet is an amount that would change change a knowledgeable financial statement user. They don't have to be knowledgeable about the company, but they know how to read the financial statement. That's all. Okay? So a knowledgeable financial statement user that would change their decisions. Okay? That's it. Okay? Income statement. Same answer. Cash flow, same answer. Notes to the financial statement, same answer, right? Okay, so what's material? Okay. Major consideration in determining the appropriate audit report. Okay? Reference an auditor's responsibility section of the audit report. What is meant by the term material? Okay. Auditor responsibility to determine whether the financial statements are material misstated. Auditor will bring material misstatements to the client's attention so corrections can be made. What are you going to do with all the immaterial misstatements you find? By the way, there are two types of misstatements. One is unintentional. Those are errors. One is intentional. Those are irregularities and illegal frauds. Okay? Okay? Which one do you worry more about if you find it? What's your scope for materiality on errors? What if somebody would make a difference in decision, right? Somebody would care about. Okay? All right? What is it for fraud? Existing at all. Got it? Irregularity pretty much the same way. Because if you found a really minor intentional misstatement, what do you bet there might be millions of them or thousands of them, and they systematically put in lots of little ones. So if you're doing tests and controls, and you're looking at 100 transactions out of 100 million, and you find something, have you really found something? There's 100 million, you guys. If you find one in a sample of 100, you just found a million. But maybe a lot more than that. Or maybe a lot less than that. Maybe it's the only one. We don't know. We're doing a sample. Maybe they're all wrong. Well, not all wrong. We can look at 99 and we're okay, right? But you don't know how bad it is. You just know it's really bad if you found one. You only look at 100. Everybody got that? So when your senior goes berserk, when you find 3 out of 100 in a sample, or 2 or 3 out of 30 in a sample, and they're like, oh my God, this is a horrible mess. They're extending that to the full population. We'll do that when we get to the stat sampling part of this. Okay? That makes sense? Imagine looking at 100 out of 100 million, and you find something wrong. Oh man, this is ugly. What do you expect to find? You're willing to look at only 100 out of 100 million. 0. I want to find nothing. Otherwise, I got to look a lot more. Right? Okay. Much less look at 30. That's just insane. Okay. All right, good. steps in applying materiality, set the materiality for the statements as a whole, right? This is the planning phase. Determine performance materiality. What is that? Okay, you're going to segment it to different areas, right? So if I know materiality for the balance sheet as a whole, balance sheet I like better because income statement's tougher because revenues and expenses are really big usually. It's really related more to net income, isn't it? Right? Which is a smaller number than either one, right? Okay. So it's really related more to net income. On the balance sheet, though, for the total assets, you've got a scope for materiality, right? How much would be material? What do? Spread it across all the different categories of accounts, and maybe even all the accounts if you want, depending on how the firm does it. So when you look at the audit program, they give you the scope for materiality for cash or for receivables or for inventory. That's the portion you assign to that area, right? That's how it works. Okay, good. Those who've been out there doing this, yeah. I did mention last time that the total materiality, say on the balance sheet, if you added up the materiality in every single account, it would be more than the total scope of materiality. What is the firm hoping for? By the way, the higher the level of materiality, the lower the level of audit you have to do, right? Because you have to take the balances in the account, basically add and subtract the materiality, and that range, right, is how much you can live with. Somewhere inside that range, your estimate has to be, or you think the client's estimate is wrong. Again, when we get to the stats sample, okay? But yeah, so that scope for materiality around it, if it's wider, more materiality on it, you have more chance of getting inside there with a smaller sample, with less work being done. Okay, if it gets tighter and tighter and tighter, if your scope of materiality is 0, guess what? You have to have exactly the same number they do, which ain't gonna happen probably. Okay, tough to get there. Got the idea on this a little bit, you guys? Okay. The important thing about understanding statistics when you're an auditor is knowing what you're doing, not being able to crank the statistics. Does that make sense? Statistics is not separate from auditing. We're taking samples, you guys. It's an integral part of what we do. So you need to intuitively understand what you're doing here. Okay, cool. We estimate the total misstatement in the segment and estimate the combined misstatement. Compare combined estimate with preliminary or revised judgment about materiality. What's going on here? I am setting scopes for materiality in total and across all the accounts, and then I'm going to estimate what? How much they might be off by. So think about this. Let's say I think I can live with $5 million error, right? Big, right? I can live with a $5 million error. That's how much I can live with. That might be my scope of materiality, right? Plus or minus $5 million, and I'll say it's fine. Won't make a difference to an informed decision maker. You see the statements. $5 million with, okay? And maybe that's on net income even. $5 million. Okay, that's my number. All right? And I'm going to spread that across all the revenue expense accounts. Get the idea? $5 million. What if I estimate that they might be off by, $4 million? Oh, man, I'm in trouble. I've only got $1 million leeway. Got the idea? What if I estimate they're only going to be off by, maybe $1 million? I can live with 5. I think the worst it might be is 1. I love it. Why? I need big samples. Because my expectation is very little error, right? Then I can live with a pretty big chunk. Got the idea? The closer your estimates for the error and your scope for materiality get together, what happens to you? Bigger and bigger sample sizes. What if what if your expected error is bigger than what you can live with? For crying out loud, don't do the audit. You're not going to be able to give an unqualified opinion. You're expecting it to be more messed up than you can live with, right? So it either becomes an extremely expensive audit or impossible to do, which I think is the same thing. Good. Beat that to death. I just beat everything. Auditors set materiality thresholds early in the engagement. Let's hope so, or you can't do anything. Thresholds represent the maximum amount the statements can be misstated and still not affect users' decision. Materiality is a relative rather than absolute concept. No kidding. Relative to what? You know what? If I have 0 net income, my scope for materiality is going to be kind of small, but it can't be 0. Make sense? But the psychological impact of being small loss or small gain is huge. Versus if they have 100 million in net income, relative to where you're at, how big things are. Benchmarks are needed for evaluating materiality. By the way, a lot of times people will say, well, let me ask you this. What's a material number? What's a material amount? Give me a percentage. Depends. That's a good answer. Depends on everything, right? You can't do that. Do firms have thresholds for materiality? Like I run across this, 5%, 3% on different types of accounts. Yeah, be careful with that. Somebody in the firm is obviously, let's hope, coming up with what's a reasonable number for different types of accounts, right? In a normal situation. You don't quit thinking because of that, though. And qualitative factors affect materiality. I already mentioned if it's fraudulent, scope for materiality, they're doing it, right? They did something illegal, right? Intentional, illegal, right? Unethical, right? Versus it's an error. Well, yeah. So all kinds of qualitative factors can affect it. All right. Considerations that may render material or small quantity, you're going to violate a loan covenant. It affects management's compensation. It's changing a trend. Conceal an illegal act. Okay. Accounting and auditing standards do not provide specific materiality guidelines because we don't know what those would be. So you use, guess what? What's the answer, everybody? Professional judgment. Professional auditor judgment. Absolutely. Good there. Okay, define performance materiality during planning. Okay, determine. All right. Evidence is accumulated by segments rather than for the financial statements as a whole. Oh, no kidding. I don't know about you, but I think I do a bank reconciliation and confirmation of cash on cash. I don't think I do it on the whole balance sheet at once. Obviously, right? I do confirmations of receivables too. I might do subsequent cash receipts on receivables. I probably don't do subsequent cash receipts on accounts payable. I could do, I guess, subsequent cash disbursements there, but obvious stuff, right? So what you're seeing is you're accumulating evidence by really accounts a lot of times. But it's not just accounts. Remember what we said really early on? It's cycle-based. So I'm looking at accounts receivable cycle. Not use that last one. Let's use inventory. Let's do inventory cycle. What relates to inventory? They don't have to call it the inventory cycle if they don't want to. They can call it purchasing or conversion. It's manufacturer's conversion. Purchasing is merchandise inventory, right? So what happens in the inventory cycle? What accounts are affected? Think of the journal entries that happen. How do you buy inventory? What do you do? Nothing to buy inventory. The cash disbursements does it. What are the entries? What's the first thing you buy inventory? I usually perpetual. I debit what? Bought inventory. Inventory. I credit what? Almost everybody buys on account. Accounts payable. Credit accounts payable, right? And then, by the way, what if they're periodic? They'll throw this crap in, by the way. Right in the middle of some CPA exam section you think doesn't have anything to do with it, right? If it's perpetual, of course, it's debit inventory. If it's periodic, it's debit what? Purchases. And you guys just have this, right? It's just part of your knowledge set. It's in there, honestly. So yourself relax, don't panic, right? Okay, so yeah. So anyway, I'm going to debit inventory or purchases. I'm going to credit accounts payable. Then you pay it. So what do you pay it with? Cash. There's your cash disbursement. Debit, accounts payable, credit, cash. Okay, expand. More than that. Oh, you mean you might debit cost of goods sold and credit inventory? If you're perpetual? No, I'm saying that when it's in the inventory. When it's in the inventory, it's still inventory in the balance sheet. Once you sold it, what does it become? Cost of goods sold. So if you're perpetual, it's debit cost of goods sold, credit inventory, right? Yeah. Oh yeah, all these things tie together. I mean, this is just obvious, isn't it? But if it's periodic, at the end of the period, I count and I compute how much is inventory. And guess what? And how much is therefore cost of goods sold. I effectively debit cost of goods sold and credit inventory because I end up with it on my balance sheet and cost of goods sold. It's the same process. Just do it at different times, right? Not as good in essence. Okay, give me some more accounts. We got cost of goods sold, we got inventory, we got accounts payable, we got cash. Cash, that's everything. Okay, what else? By the way, when you're auditing cash, don't audit every other account in the general ledger because it gets touched by cash, okay? Or you go crazy, right? So you arbitrarily separate it up. What else?
Purchase discounts.
Oh, purchase discounts. That was another one, right? Doesn't that affect purchases and therefore cost of goods sold? Net purchase and cost of goods sold. Sure, purchase discount. Got another one? It's really closely related. Purchase returns and allowances. Yeah. Now you could go to sales and sales discounts and sales returns and allowances, but now we're out of the inventory cycle, aren't we? We're now into the accounts receivable sales cycle. Yeah, they're arbitrary. Give me some more though. We're getting a few accounts, aren't we? What else? How about freight in? Not freight out. Freight out relates to sales, right? Freight in relates to what? Purchases. Although freight out is the units that are sold, so I guess it kind of relates to cost of goods sold too if you want to. You can do it that way. You go either direction, couldn't you? Okay? Where does it make more sense to do it? How about sales commissions? Not on inventory, that's on receivables, right? Okay, guys? So imagine everything that goes into, well, you know what a cost of goods sold schedule looks like, right? Beginning inventory, plus purchases, less purchase returns and allowances, less purchase discounts is net purchases, plus freight in, plus taxes and duties, if you've got them, right? What am I leaving out? All kinds of stuff. Okay? And then we get our total available, don't we? Right? We get net purchases, and then we add to that the beginning inventory, and we've got total available. Then we subtract the ending inventory, and we have cost of goods sold. How hard is it to find the accounts that go inside? Think of the ones on the balance sheet too, of course. Right? Okay. Inventory, accounts payable, cash, whatever else is out there. Okay? I guess. Oh, by the way, if I'm doing freight out, might it also be wise to do prepaid freight and freight payable at the same time? In fact, what I might do is prepaid freight and freight payable, and as a byproduct of that, I get freight expense. Right? I like expense to fall out by doing substantive work in the other areas. But everybody got it? Or you know what? I think these analytical procedures were very good. Only this analytical procedure might be more like this. If I'm paying freight, I have UPS do it, and I'm paying so much per package, I could do a formula where, how do they bill? So much per package, right? And then so much per pound, or ton, or whatever it is. Well, I guess it's pound, it's UPS. Okay, so if I've got those two things going, could I find out what my average order is like? Average order is 1 over, and what does it weigh? Right? And then do what? If you figure out about how many orders I have, get the cost per average order times the number of orders, what do I got? Right. That'd be out, I guess. Right? Sure. That's an analytic procedure, you guys. See, they can be kind of sophisticated or kind of simple, huh? Good. As far as you want. All right, evidence is accumulated by segments. Most practitioners allocate materiality to balance sheet accounts. No kidding. Use materiality, okay? Whoops. Use materiality to evaluate audit findings, okay? So, really, in order to determine the misstated amount in an account, okay? Well, maybe we can come up with an estimate of the misstatement in an account. Okay, is a better way to put it. They say known and likely. Well, known, we actually find a particular one. Likely, well, we're not sure. We didn't find that particular one, but even then, they're estimates. Two types of likely misstatements: judgment differences and projections of misstatements from audit samples. So you find a misstatement in an audit sample, you now know what the misstatement is in the whole population? Of course not. Okay? You look at 100 items, you look at 50 items, and there are, 5,000 of them, right? So do you really know? No. So we'll put a confidence interval around it, though. Come up with an estimate and a confidence interval around it. Okay, so here's a total misstatement, estimated total misstatement in preliminary judgment. So our total, I guess, that we're willing to live with, in their example, they made it add up. I guess 50 spread across cash, receivables, and inventory. We come up with a known and our direct projection of what the errors look like. Wow, 45. And then we have a sampling error. What would that probably be? What do you think? This is what we find and what we estimate. What's this thing? Because I didn't look at everything, I make an estimate of how far off I might be. if I had looked at everything, I might be that much off. And what we'll do is we'll have a 95% confidence or a 90% confidence. Usually wouldn't use 99 because it makes it too big a number. If you want to be 99% confident, you got to look at a lot of stuff, right? But if you can live with 95 with good internal control, you might be fine. 90 with decent internal control, you might be fine. Okay? So this sampling error is how much I might be off. I haven't found those errors, but it's how much I think I might be off because I took a sample. I didn't look at everything. Remember that from your stat class a little bit? Maybe it's okay. We'll mess with it. We'll mess with these. Okay? So we think we might be as much off as 62.3. What would you say? Oh, no. Right? Oh, no. Okay. Anyway. By the way, why do they have nothing here? That's good. They got a nice example of nothing. Why would there be no sampling there on cash? We confirmed every single account. We took 100% sample. Why is there a sampling error on accounts receivable? We didn't look at everything, right? Okay, take a sample. On inventory, even worse, huh? Okay. The other thing that can drive the sampling error is we found mistakes. We find no mistakes, it keeps it down. You still have some, right? Allows for sampling error. Okay. But if you start finding mistakes, it gets bigger and bigger. Okay. Get into that stuff. You thought this was going to be easy too. Okay. Let's go to an example. They've got the net misstatements in the sample that they found. That's how much they were off by, right? And then the net misstatements in the sample divided by the total sample times the recorded population value. And what we do is we get a percent misstatement is what this is. Make sense? Times the population as a whole gives me how much I think I might be off by. I'm just extending my sample to the population. Everybody okay with that? Not a big deal. You can do that a variety of ways, by the way. You might do it per account, how far I think each account is off, and then take that times the error per account that I found in my sample times the number of accounts I have and get the total that way. We did a percentage this way, which is a ratio approach. Right, a couple different ways you can do it. We'll look at those when we get to the sample chapters. Risk in auditing. Auditors accept some level of risk in performing the audit. Risks exist, are difficult to measure, and require careful thought and response. Proper risk response is critical, of course. Okay, that makes sense. Auditors need to understand the client's business and assess business risk. The audit risk model helps identify the potential statements. And so here we go. This is it. The planned detection risk. Okay, I just called it DR last time. The acceptable audit risk, I just called it AR. Inherent risk and control risk. And all they've done here is mess with the formula, right? If you know your audit risk and you know your estimate of inherent risk and you know your estimate of control risk, you can determine how much detection you want to do. Okay. If you want the detection risk low, what happens to your procedures? Substandard procedures. Tests of transactions and ending balances. What happens to substandard procedures? I'd like my detection risk to go lower. What am I going to have to do? Do more. Okay. On controls, what's the deal? I want my control risk to be lower. What I would say there is too bad. You can't make the control risk lower by doing more work. Why not? It's what it is. You do a preliminary evaluation of it, obtain an understanding of controls, do a preliminary evaluation of the control risk, which is the risk of there being a material misstatement happens, right? Controls didn't prevent it. And the risk that they didn't identify it, right? Determine if there was an error and correct it. Correct the controls. Okay? That's what this is. So you do your preliminary evaluation. And why are you testing? To find out if your evaluation is right. You thought the controls were good, right? Now you test it to find out if they are. Once you've tested and found out they are, it doesn't do you any good to keep testing. Or you test them and you find out they're bad. It doesn't do you any good to keep testing. Don't bother. Versus on a substantive testing, what can you do? You can keep looking and looking and looking and looking. You can look at 100% of all the transactions in the company and 100% of their balances, right? It's audit. But you could do that, and you could feel comfortable with the audited financial statements, couldn't you? Right, guys? You can keep doing more detection work. Okay? Everybody good? So this little formula allows you to calculate. They just moved it around, right? Allows you to calculate the detection risk that you're going to be willing to live with. By the way, at this point, let's say you did a preliminary evaluation. You got your audit risk, you've got your estimate of inherent risk, you've got your estimate of control risk. You haven't tested it yet, right? You're doing this in planning. And you come up with a detection risk that you can't live I must reduce my detection risk to 1%. Turn down the audit. Walk away, and you're already in. You've already done a bunch of stuff that you're probably not going to collect for. We can't do it. We're not doing it. Okay? It's got to be a reasonable amount, right? At the very least, what you can do, let's say it turns out to be something ridiculous like 10% or something, right? You can tell the client how expensive the audit's going to be, because those standing procedures are going to just skyrocket. You've got 1,000 accounts receivable. I would like to look at 700 of them, okay? I don't believe your numbers. I'm going to look at all the ones that are big at all. Little ones I won't look at. Oh, no. I'm going to do a representative sample of those too, because you might have lied in those. I don't know. You might have screwed them up, and maybe they're really big and it looks small. You're screwed. Yeah, okay. So do it early. Okay, audit risk model for planning. We've already done this. We've done this. We've done this. What do? Assess the risk of material misstatement, separated into inherent risk, and then how well have they controlled it. Got it? That kind of makes sense. Beat this to death. Okay, and usually we don't have percentages, although what a lot of firms will do is they'll apply a percentage to each of these. I'm doing better than I thought. I guess I hadn't covered a lot last time. We say medium, low, and high. What percent do you think those might be? If you're going to try to put percentages into your audit risk model, you'd have to assign percentages to these, wouldn't you? What percentages go there? What's high? What's low? What's medium? Well, first, what do we mean? Before we try to put percentages on it, what do we mean by medium inherent risk? Inherent risk is the risk of the material misstatement in the financial statements, in the absence of controls, and in the absence of us doing any auditing or collecting evidence. Right? By the way, if we do a whole bunch of detection stuff, we will find the errors that inherent risk cause, the errors and the mistakes in general, right? Errors and irregularities both. If we do lots and lots of detection work, we'll find those, right? So we've got medium here. What does that mean? There's a medium chance that there'll be a material misstatement due to their sales and collection cycle, right? The way the company's set up. It doesn't have anything to do with their controls. But then if they have medium control risk on it, what does that mean? The controls won't prevent those errors, right? Although medium times medium might not be too bad. So then the acceptable audit risk is low. Why? I'm sorry, the planned detection risk is medium. Why? Because we got a low acceptable audit risk. If I want a low acceptable audit risk, medium times medium times medium must be low in this case, huh? So if you put 5% on acceptable audit risk, presumably whatever percent inherent risk is times control risk times detection risk is going to hit that 5%. Got the idea? So what might median be? What if it was 50%? Somebody take 0.5 times 0.5 times 0.5. 0.125. Boy, is that low. Is that no, it's not low. It's 12.5%. Okay, still pretty low. Okay, fairly low. If they want very low and they wanted to get down to 5%, what are we going to have? What would that be? Maybe 0.4 times 0.4 times 0.4. What does that get down to?
0.064.
Oh, that's about 6%. That'd be pretty low. You guys with me? So is there a 40% chance of the inherent risk causing an error, a 40% of control, a 40% left that we won't, the control, 40% chance the controls won't find it or prevent it, and then a 40% chance that we won't find it if there still is one. Because the inherent risk is the first thing, right? And then the controls limit those misstatements, and then our detection finds those misstatements. Got it? Even clearer? Okay. Saying it a bunch of times kind of helps. And they get to medium here on the acquisition and payment, even though inherent risk is high. Why? Because they have really good controls. Right? Everybody good? And then medium detection is fine, and we still get the low audit risk. And if this is low everywhere, right? Low inherent, low control risk on both of them. Yeah. And we don't care too. Actually, I would have preferred they say acceptable audit risk be higher, maybe. Right? Because you could make that medium if you want to. And then what does that do? Let your detection risk go even higher. Getting the idea here, you guys? I like to use numbers personally. I like to actually put percentages in there. So anyway, they risk components, plan detection risk, control risk, inherent risk, reciprocal audit risk, we beat that to death. What's engagement, impact of engagement risk on acceptable audit risk? What's engagement risk? Closely relates to client business risk, they say. What's that? A lawsuit. Yeah. What's that?
I said, like, even if you gave the right patient chance that a client or somebody comes back in.
Yeah, sure. Okay. So the degree to which external users rely on the statements. The more external people are, the more risk we've got. It's just true, right? They might come after us. The likelihood that a client will have financial difficulties after the audit report is issued. How close are they to bankruptcy? Are they close to being a going concern problem? By the way, a going concern, how long do they have to stay in business to be a going concern? What's our rule of thumb? 1 year. Yeah. And really, it's supposed to be in perpetuity. But if we say if they're going to make it a year, take out my crystal ball, they're going to survive for a year or more, I'm okay. Right? So otherwise, I'm going to give them a going concern. By the way, is that a qualification? No. The emphasis of a matter, I think it's nuts. I like it better when it was a qualification. It's called a subject to. We'd say subject to continuing to exist. These statements fairly present. Now we just say, oh, by the way, they might not exist in the future. Isn't that a qualification still? What would you think? If you read a financial statement, an auditor's report on a financial statement, said, oh, by the way, I don't think they're a going concern. I think the auditor is qualified. We just don't want to call it that. We want qualifications to be for what? GAAP violations and... You guys tell me how easy this is. Come on, what is it? Scope limitation. Good. GAAP violation, scope limitation. Good. Those have got to be right. I know you're going. Hard to stay awake. Yeah. All right. Me too. The likelihood. I can talk while I'm sleeping, so that's pretty good. With my eyes open. Yeah. The likelihood that a client will have financial difficulties after the report's issued, of course. And then auditor's evaluation of management integrity. This one's big. Develop really good relationship with your clients. I don't mean golf with them every day. I don't mean drink with them every night. Okay? What I mean is get to know them really well. So they know you, you know them, they trust you, you trust them. You know, everything's above board, and you know they have high levels of integrity. And I would know with my clients, and I'd get really nervous when I saw evidence that they lack integrity. Okay? So, and that's separate from what their religion is, or what their political affiliation is, or if they like the same sports you do, or they like sports at all. Who cares? They don't even have to drink, and they trust them honest. Well, maybe not quite as much. Yeah. All right. Yeah, I don't care what they do in their personal lives and what their belief structures are. I care how much integrity they've got. Right? So, by the way, are people who are more religious, do they have more integrity? Only if they internalize their belief structure when they actually use it. Going to church doesn't cut it, right? Okay, so, be careful. And it doesn't mean if somebody shares your political views that they have high integrity, that you think that somehow has something to do with integrity. All right, anyway. So methods we use to assess acceptable audit risk, external users' reliance, we talked about that. Read. Likelihood of financial difficulty, we talked about. Management integrity. Follow procedures discussed in Chapter 8. Okay, again, for client continuance. All right. So, what kind of things affect inherent risk? So this is good. Nature of the client's business. I told you about wildcat oil drilling, right? High risk. Toy business. Higher risk. Yeah, so it used to be that banking was extremely low risk until we deregulated banking. Now banking is pretty high risk business sometimes, right? They go bankrupt, don't they? Get bought up by other companies. Changed the whole world. Utilities used to be low risk. We deregulated utilities to a large extent. Much more risk. They were protected by being regulated. They also had lower profitability by being regulated. They wanted to get rid of the regulation. Banks did. Regulating industries in general did. It's a double-edged sword, though. You have more opportunity for profitability, right? You also have more opportunity for what? More return. What do you get with it? Almost always more risk. More competitors come in. Nothing else, right? They'll take your business away from you. Okay, so industry practices, non-routine transactions, so they got lots and lots of really unusual transactions for it, right? Sure. Okay, if everything's a different thing, they just keep doing different stuff, different ways to make money, right? That's big. On Enron, they were supposedly creating whole new industries. And really, if you think about it, if you look at somebody like, what's a high-tech one now that would be, actually, some of the high-tech ones are kind of having trouble, I think. I think, is it Google is having a little trouble? Is it Google? Twitter is. Yeah, Sony's had some problems. Companies that years ago you wouldn't have thought would, even a few years ago, with something like Twitter or Facebook, they're not going to have any trouble ever, right? And there was a time when Apple was about ready to bankrupt. That's not true anymore. Although their stock took a big dive because they didn't earn as much as everybody thought they were going to, even though they earned a whole bunch, right? People were making fun of it because it was one of the largest profits any company's ever had, and their stock value went down because people thought they had more, right? So all kinds of things can affect it. But in those companies, even big ones like that, sometimes they're really tied to how good the new product is. Apple's fortunes are really tied to how good the new one is, and the next new one, and the next new one. And so if a company's in that sort of situation, that can affect it, right? So sure. Okay, audit experience, have we done it before, right? Have we done it a number of times? Auditor judgment required to correctly record balances and transactions. How much do we have to be involved in? And then just the culture, and that gets back to integrity, how they run the business, how secretive they are. Secretive worries me. I don't mind people keeping trade secrets. I think it's a real good idea. And sensitive information inside a company is just fine, what people's salaries are. That's okay, right? What your future plans are, and that sort of thing. But when they're keeping secrets from each other, or they're keeping secrets from their auditors, what? We got confidentiality, right? We're not going to tell anybody anything. Why would they not want to share information? What's that about? I start getting nervous, okay? And you'll observe partners and managers when they're in those environments, and seniors too, when they're in those environments. And you might sit in meetings and they're not. Are they telling you about this? They're not telling me about it. What's going on here? They don't want us to know what's going on in the business. We're trying to audit them. So that kind of thing. Okay, or they just don't want you to know that they have related parties. You have to struggle to find out who the related parties are. Why? Why didn't you just tell me who they are? Or areas in the business where they're at risk. By the way, what's human nature? Do people really want to tell you things they're having trouble with? Or do they want to talk about things that are working out real well? Human nature, right? So, use your head about this, right? But, I'm on your side. I need to know what's going on. We need to report the truth. I'm not being judgmental here. I want to happen. What do you do? But if you're asking all kinds of questions about the business in general, and you're continuously talking to them, that stuff's not going to happen to you too much, right? Don't be separate from the client. Also, don't be best friends with the client. Get your independence and your professional skepticism. You're pretty close. Not too close. With your professionals. Although I have some faculty, I guess I would share that too. I think it's really close for me to be close to students, but not, it's really important for me to be close to students, but not too close. What would you guys think if I hung out with, I'll pick, I want all the women. So all the women and I hang out together and we go out for drinks. We become really good friends. And you guys are just exclusive. They'd be thrilled they don't have to go. I know that's not a real example. But if that were the case, what do you think? In this environment, don't show favoritism to anybody. I show absolutely no favoritism. That's true. Some of you guys have done really well on exams in my classes. What have I told you? Yeah, nice job. Big deal. You'll impress me if you become a managing partner in a big four firm. You donate $100 million. No, not that much. They're too cheap. You donate $20 million is my game without scholarship funds. I'll say, way to go, good job. Prior to that, you just make a living, right? So, they treat everybody equally and everybody fairly and to the extent you can. And then you can love the hell out of your family members, your significant other, right? So, Don't go there with your clients or your colleagues. Or, by the way, do you like some colleagues better than others? You guys work with some auditors. Some are really fun. Some maybe not for you at least. How about clients? Anybody work on a client that was miserable? Yes. You didn't get to do that yet? Oh, you will. She's maybe a little bit. Yeah, you don't have to tell us who it was. And have you worked with people that are really a lot of fun too? Yeah. So you can decide how you want the company to be that you work for. So, okay. I guess you guys are leaving or something. I'm almost done with this chapter, aren't I? You don't have a clue. Did you read it yet?
Nope.
That's good. Well, when you read it now, wow.
I need to read it after.
Yeah. Well, apparently I talked about this one last time anyway, so everybody. I do not care when you read the chapters, you guys. All I care is that you guys. I hope you get a decent grade. But I want you to pass the audience section. That's my goal for this class. And then you can go learn how to do audit work, right? Or not, to do taxes. Right? Yeah, no, shake your head, yeah.